Hello?
Hello,
Hi, who's this?
Bradley.
Hi, Bradley. We're going to get started in a few minutes. You could just put yourself on mute.
How do I do that?
That'll be good. Thanks. Thank you. Okay, guys, I think I'm going to get started. I have 3:07 on my phone. So I just want to remind you that this is being recorded. So if you wanted to come back to it, I'll have it posted so that you can access it. Today, what my objective is to get through Learning Objective 1 in Chapter 6, which deals with deductions for adjusted gross income, which a lot of them we've already looked at. 1 or 2 or 3 we may need to talk about. Then Learning Objective 2 in Chapter 6, we're going to start talking about itemized deductions, and we're going to talk about medical expenses and state and local income taxes today. When we come back from Thanksgiving break, we're going to wrap up Chapter 6 and Learning Objectives 1 and 2, and Chapter 14, Learning Objectives 3 and 4, talking about mortgage interest and charitable contributions and any other itemized deductions. A lot of them have become disallowed with the new tax law, so I'll bring those up, but that's what I'm sorry. The itemized deduction section has become a lot smaller than it once was, but we wanted to let you know about them in case you should see something out there. You'll know, oh, that's from a past law. Then when we'll start going into Chapter 8, which is on tax credits. When we get back, we'll probably spend more than I'm seeing going into Chapter 13. We may only have one class on that, a class and a half. So we're right on schedule. We're okay. So we can get this stuff all in, and that's why I wanted to have class today, even though a majority of our campuses are closed. So I'm first going to share my screen so you can see my simulated 1040. And you have access to this, and it's just a 1040, but I changed some stuff on it because I know it went away. So if you have a 2017 version, you can grab that and make these modifications, because that's all this really is. But that's what Chapter 6, the first learning objective, is focusing on. And I will see if I can make this a little larger here so we could focus, there we go, on deductions for adjusted gross income. So I'd like to look at each of these in the sequence they're already on the 1040, and you'll find these throughout that first learning objective. Okay, so line 23, and then I'll probably have to keep flipping back and forth between Word and this, so bear with me. But you could jot this down. I don't need to put this in a Word document. Line 23 is an educator expense deduction. And this is discussed on page, oh, they don't even have it in here. I thought it was. I know we talked about it. Oh, nope, that's not it. Sorry, guys. This is actually a deduction available to K through 12 teachers, principals, and counselors. K through 12 only. So college teachers don't count. What can they deduct? Up to $250 in school supplies that they pay for out of pocket. So somebody lobbied Congress to get this deduction because teachers are out there spending their own money, and I know that, on supplies because the school isn't able to supply them. So Congress is allowing educators to deduct school supplies related to their teaching, whatever coursework they're teaching in. Okay, so you just have to keep your receipts and prove that you're in that position, and you get to take that deduction as a teacher, counselor, or principal. Line 24, I'm not worried about. That's very specific. It's for people who are reservists, performing artists, and government officials. We're going to skip down to line 25. Health savings account deduction. Health savings account. This is a deduction for individuals who are in a high deductible health insurance plan. So you have insurance, but you have to pay maybe $5,000, $6,000 of your expenses before your health insurance kicks in, the high deductible amount. So when you have a high deductible insurance policy of any kind, your insurance premiums tend to be lower. So that's why a lot of employers are going towards that kind of health insurance. Health insurance premiums are low, but the deductibles are high for the employees. So what Congress said is, well, hey employees, if you open up a savings account and save the money for the deductible portion of your health costs, we're going to allow you to take a deduction for the amount you save as a deduction for adjusted gross income. Now, the key here is that you are in a high deductible insurance policy. So, like my deductible is $100. I don't know, it doesn't qualify. So if I open up a health savings account, that's great, but I won't get any deduction for it. So it's for people with those high deductible insurance policies, amounts they save to a certain amount. It's not all. There are limitations on how much, but they're generally deductible for adjusted gross income. Line 26, moving expenses. Now, these are directly in your chapter. Before the tax law change, a lot of people, everybody, was eligible to deduct moving expenses. As long as you moved because you changed jobs, changed job locations, and your commute, your new commute, was more than 50 miles. If you stayed in your old home, and I'll put this up on Word in a second. I'll do it right now. So just bear with me a sec. Let me share my Word. I may have to open it. Okay. Nope, I don't want to do that. Just bear with me, guys. I'm kind of a novice here with using. There we go. There we go. Okay, using the Zoom. I know enough, though. Okay, so moving expenses pre-2018. You could deduct expenses of moving if you changed job locations. number one. So you don't have to change companies. You just had to change job locations. And your new commute from your old home, so if you stayed at your old house, was 50 miles more than your old commute. Okay, so this was a substantial job location change. So what this is saying is you changed your job location. You live currently in Wilkes-Barre. Okay, so that's your old house. Your old job was in Kingston, which was a 5-mile commute. Okay, if you stayed in your old home, where's your new job? What would have been your new commute? Well, let's say your new job is in Philadelphia. Philadelphia, there we go. 90 miles away. What this rule is saying is that your commute from your old house to your new job has to be more than 50 miles more than your old commute. So if you stayed in Wilkes-Barre and commuted to Philadelphia, you would have had to drive 90 miles. Well, that's more than 55 miles, so you qualify. That's kind of funky, but that's what it has to be, a move that's worth it. If you switch jobs from Kingston to Wilkes-Barre, come on, you could stay in Wilkes-Barre in your old house. I mean, you can move, but your moving expenses aren't deductible. And that was the whole real, kicker. Those were the rules behind moving expenses. Well, guess what now? So post 2017, you can only deduct moving expenses if in the armed services. Okay, so it's not, it doesn't matter if you moved 1,000 miles. None of your moving expenses are deductible now. They used to be a deduction for adjusted gross income, and you could see that on the 1040. Okay, I'm going to go back to, let me see if it'll let me. Oops. New share, go back over to my 1040. The next is deductible part of self-employment tax. Deductible part of self-employment tax. So let's take a look at that. It'll let me go back over. Yep. Let me tell the screen I'm sharing something new. There we go. Okay. So the deductible portion of self-employment tax. Let's go back and talk about self-employment tax. Remember when you were a sole proprietor and you figured out on your Schedule C the taxable portion of your income. So your taxable income, business income, on the Schedule C. This isn't taxable income on the 1040. This is the amount that gets transferred to the 1040. Let's say it's $40,000. Well, not only will you transfer that to your 1040 and pay regular income tax, you also have to pay FICA and Medicare tax on it as a self-employed individual. Self-employment tax. Now, if your income reaches a certain level, I think it's 128,900 in 2018, you may not have to include all of your business income in computing the tax. But here, it's only $40,000. And we're assuming this is your only income. You don't have a job. You don't pay FICA tax anywhere else or Medicare. The tax rate then on this $40,000 for self-employment tax is 15.3%. So not only will you pay income tax on that $40,000, you also, on your tax return, calculate your FICA and Medicare on that, which would be $6,120. Now, let's shoot back over so you can see where that was being reported. Remember, line 57 of the 1040 right here, that's where you add in your self-employment tax to all your other taxes. What this rule says is, oh, let me flip back over. Take 1/2 of that amount, 1/2 of the 6120, $3,061, and you could deduct it for AGI. So coming back over to my 1040, that's what this line is. Deductible part of self-employment tax is the 1/2 of the self-employment tax. So you can take that as a deduction for adjusted gross income. They talk about this on pages 6-7 to 6-8. Also, your moving expense information is there as well. Line 28, we're going to bypass that for now, but these are SEP, simple, and qualified plans are all retirement plans for self-employed individuals. So generally, if you make contributions to a retirement plan, one of these types, in Chapter 13, they talk about how much you can contribute and deduct. You may have a deductible contribution for adjusted gross income. Self-employed individuals get this. Line 29, self-employed health insurance deduction. So let's talk about that. I'm going to flip back over to my Word. I'm starting to get the hang of this. Self-employed individuals who carry their own health insurance may be able to deduct the premiums related to them that they pay for themselves, their spouse, and their dependents. Okay? They are limited. The deduction is limited to business income on the Schedule C. So you can't deduct more than your ultimate business income. So if you have a loss, you're not allowed to take the deduction. Also, here's another limitation. If the self-employed individual is eligible to be in an employer-sponsored health insurance and just chooses not to, there's no self-employed insurance deduction allowed. So I want to talk to you a little bit about this. My brother gets this, happens to him. Let's say you are self-employed, you're single, okay, and you make $6,000 in health insurance payments, premiums on your health insurance policy. Your business income is $10,000, so business income $10,000. Insurance premiums, health insurance premiums. These are not deductible on the Schedule C. If you remember back to the Schedule C, it says insurance, except health insurance on the self-employed person is $6,000 or $6,000. This person has no other means of getting health insurance, then that $6,000 is deductible as a deduction for adjusted gross income on that line. Let's say you have the same scenario. You're married though. Business income is $10,000. Your spouse works. They are in a health insurance spouse is in a health insurance program. You are eligible to also be in it, but choose not to. None of the $6,000 is deductible. You chose, you had a choice, and you chose to take this out on your own. Too bad. Happens to my brother. I think he might have changed it though now. For many years, his wife works at a law firm. They have a very high-end insurance policy. It's a very nice insurance policy, but the employees pay into it. The spouses are eligible to also be covered. But when it came to the coverage, I think let's just say, if he took the coverage through his wife, the spouse, it would have cost them $7,000 a year. And just think of it in this respect. Let's say this was my brother. So his choice was pay $7,000 through his wife's insurance policy or get his own insurance policy and pay $6,000. Well, it made more sense to get the $6,000 one, but the IRS doesn't care, and Congress. You don't get to take that as a deduction because you were eligible to be in the wife's. Go and do that. So that's one, kind of unfair thing there, but it is what it is. So please remember that. Also, remember children under the age of 27, because we're still required to keep health insurance till that age. So any premiums related to them as well, as long as they're not eligible to participate in a health insurance policy. So if they're working full time, they're still your dependent, but they have a chance to be in their health insurance, well, that's different. Then you cannot deduct that, just like you can't deduct if you're eligible. Okay, so that is what goes on line 29. Line 29. Line 30, we've talked about this a little bit already. Penalty on early withdrawal of savings, and they talk about that on page 6-8. So let me go back over and just review that. Penalty on early withdrawal of savings is basically if you have a time deposit, meaning you gave the money to the bank and said, you can keep this money for a year. That's a time deposit. You're restricted. You can't go and take the money out during that year without penalty. Certificates of deposit are your classic time deposit. So let's say you take out a 1-year CD, certificate of deposit, that will earn $100 in interest over that year. 9 months in, you need to take the money out. Okay. Well, what the bank usually does there is says, well, you can take your money out, but you're not getting any interest. We're penalizing you that interest. What the bank does is reports the $75 as interest income to you, okay, on a 1099 INT, and you're required to put that in your gross income. But then you can deduct the $75 because you never received it. It was a penalty on early withdrawal as that. So it just washes it out because of the requirements of the law. And that's what that is. So are there any questions? You could unmute yourself and ask, or I'm just kind of going along here. So if you have anything, stop me. We could talk about it. Okay, then I'm going to keep on flying. Let's go back to our 1040. We're getting there. Alimony paid. Remember, when it comes to alimony, when you have a divorce decree that's signed after 2018, you cannot deduct any alimony payments. But if your divorce decree was signed before 2019, any alimony payments you make in 2018 and into the future are still deductible. So this line isn't going to go away, but only a limited number of individuals will be able to use it. Remember, it's the alimony that is deductible, and we talked about already what is alimony. So just because somebody says, oh, I have alimony, doesn't mean you just take it as a deduction, or I paid alimony. You just don't take it as a deduction. The next line is the IRA deduction. That's Chapter 13. Okay, I believe the new limit is $6,000, and IRA stands for Individual Retirement Account. So we'll talk more about them, probably our last class. And then line 33. This is our last one for now. Student loan interest deduction. And this is what we all love to know about, right? Because we're going into this phase pretty soon that we'll be paying off our student loans, and interest is going to be charged on them. So the taxpayer who claims the student as a dependent is the one who takes the student loan interest deduction. So if you're paying off your student loan interest right now, your parents can claim you as a dependent. They take the student loan interest deduction. If you're paying off your student loan interest and you can claim yourself as a dependent, no one else qualifies to claim you as a dependent, then you can take the student loan interest deduction. And it is for interest on student loans for paying for tuition and fees, books and expenses, room and board, and other necessary supplies and expenses, including travel. So it's just not the tuition or the expense interest related to the loan that you paid for tuition. It's really your whole experience. Now, you just don't get to deduct it all. The most you can deduct in a year is $2,500 per person, if your income is below a certain amount. And here they are in the middle of page 6-9. If you are not married filing joint, your modified AGI needs to be $65,000 or less to get the full deduction. If your modified AGI is between $65,000 and $80,000, you phase out the $2,500. So you can take some, but not all. And we'll do an example. If you are unmarried and your AGI is above $80,000, you don't get any deduction. And those amounts are higher for married filing joint. So it phases out at a higher modified adjusted gross income. Modified adjusted gross income for these purposes is AGI before deducting interest expense on education loans. So it's everything else is subtracted that could be, except for student loan interest. So I'm going to flip back over. We'll look at an example. So let's say we have single taxpayer, modified AGI, which is different than it was for Social Security. Remember, modified AGI is just basically AGI without deducting any student loan interest, is $77,000. Student loan interest paid is $3,000. So since this person's modified AGI is between 65 and 80,000, they'll be able to deduct some of their interest, but not all. Now, further, they're not going to be able to deduct some of the 3,000. It's going to be some of the maximum of 2,500. So what we do is we take the Maggie, 77,000, subtract it from the lower end of the range, which is 65,000, and then divide it by the range, which is 15,000. It phases out over $15,000, 65,000 to 80,000. 77,000 minus the 65,000 gives us 12 divided by 15. So 80% of it is not going to be allowed as a deduction. 80% of it. 80% not deductible. So of the 2,500, only 20% will be deductible. The max you can deduct is 2,500. So, yeah, something's better than nothing. $500 of your student loan interest would be deducted. Once Maggie gets to 80,000, forget it. You don't get anything. Okay, so please keep that in mind. But that calculation would go on that last line that we have there of the 1040. So let me grab that back up right there. Now line 34 and 35 were other deductions that are no longer allowed. A lot of times the IRS will just reserve those lines for future deductions. So that's why we have the word reserved there, but there's nothing on it. They may even eliminate the lines. And they talk about those. No, I don't even think they did. Nope. One thing I want to bring to your attention, that these are all specific items after we computed gross income. Any item that was deducted up in the top of the 1040, specifically expenses in the business income, those expenses are also considered deductions for adjusted gross income because they are deducted to get to adjusted gross income. Same with any expenses in your rentals. Those are also considered expenses for adjusted gross income. Losses that are allowed to be deducted, those are also deductions for adjusted gross income. So it's just not those items in that area, and they talk about those in the beginning of Chapter 6. So I'm not going to go back through them because we spent a lot of time on the Schedule C and the Schedule E, but please be aware of that. One item I do want to bring to your attention that's pretty important. I'm going to go back over to my Word so we could do some. On page 6-6, this is something new. 2018, a taxpayer other than married filing joint can only deduct up to $250,000 of business loss. So if you have a business, you're a partner in a partnership, you're a shareholder in an S corporation, you're a sole proprietor, all of those individuals carry profit or loss from the business to their 1040. What this is saying is, if you have business loss from those types of entities, you can deduct it, but only up to $250,000 this year in total. If you're married filing joint, you can go up to $500,000. If you have loss above that amount, you carry it forward to next year. So you don't lose it, but you can't take it this year. Okay, so those are all of our deductions for adjusted gross income. Any questions? All right, then let's move on to deductions from adjusted gross income. We've already talked about the standard deduction way back when we used to be able to wear shorts, right? Standard deduction, how we compute it, how it's determined, it's based on filing status. You get some extra amounts if you're blind or you're 65 or over. There's some limitations on your standard deduction if you are can be a dependent of someone else. Okay, we compare that to, sorry, I should have put greater of standard deduction or itemized deduction. That was one. The other one we just talked about is the deduction for qualified business income. So we've talked, standard deduction, qualified business income deduction. So now it is time to talk about itemized deductions. And that's what the rest of our discussion will center around. So I'm going to call up a Schedule A, and you can find one of these probably at the end of your chapter here. On page 6-23. But mine's going to be a little different. So let me share my, back to here. I modified mine so that it's going to look more like, let me see something very quick. Sorry, guys, just bear with me a second. I meant to check this out. Nope, okay. I wanted to see if the IRS has the 2018 version, but they don't. So let me go back and I will call up the one that I created. I think. No, I don't have it in here. Okay, I'm not going to waste your time with it. We'll just use 2017's. Itemized deductions, there's only certain personal expenditures that qualify for this deduction. What we do is we figure out what we're eligible to take, add them all up, and if that amount is greater than our standard deduction, then we take it. So we're going to cover medical and dental expenses today and taxes, state and local taxes you pay. The other items that are allowed, we'll talk more when we get back from break, mortgage interest and gifts to charity. This section, casualty and theft losses, was eliminated by the new tax law. They're not allowed anymore. This section, job expenses and certain miscellaneous deductions, they've been eliminated. Not allowed anymore, so they won't be on our Schedule A. But other miscellaneous deductions are still there. So our time next time we meet will be on other miscellaneous itemized deductions, gifts to charity, and interest you paid. And believe me, they'll take up our whole time. There's a lot of rules surrounding them. So today I'd like to focus on medical and dental expenses and the state taxes you paid. So that's what we're looking at. I'm going to fly back over to my Word. So itemized deductions, medical and dental expenses. So what qualifies for a medical expense? Page 6-11. Generally, it is the payment, so it has to be money coming out of your pocket or a loan you took to pay for the care, prevention, diagnosis, or cure of an injury, disease, or bodily function that is not covered by insurance. Okay, so it's a general statement, but there's a lot of stuff that falls under there. And here's how we look at it, and the IRS looks at it. It's medically necessary, basically. The one thing that does not qualify is elective plastic surgery. Even if your insurance policy covers it, it's not allowed as an insurance deduction. So if you have to pay a deductible on that, some people have those kind of insurance policies. You can't deduct even that deductible because it was for more of an elective plastic surgery. Plastic surgery is deductible if it's to correct a deformity or an injury. What other kind of things? Payments to your medical providers, doctors, your dentist is included here. Cosmetic dentistry, no. Your eye doctors. So it's more than just, your regular family doctor or a doctor as we think of them as curing or preventing or diagnosing. This is including dental and eye. Nurses and medical facilities also. You can deduct transportation to and from your medical events. I think it's up to 10 or 12 cents a mile. Certain amount of long-term care facilities, insurance also is deductible here. Health insurance premiums you pay may be deductible here. Okay, so the part of your health insurance. Now, if you pay part of your health insurance through your employer, it's usually what we call pre-tax. Let me show you what that means. So your gross pay, you make $1,000 for the week. You subsidize or pay $50 of your health insurance each week. Your employer pays the rest. What they do before they even calculate your tax is deduct that $50. Your gross pay for tax purposes is $950. So that $50 health insurance premium you paid is never taxed. When you put that $950, well, when you put your pay on your tax return, you're only putting $950. And they can only calculate your tax on that. So when that happens, you can't also take a deduction for your health insurance premium you paid. You never pay taxes on that money. But if there's circumstances where money that's been taxed, you now use for a health insurance policy to pay for the premiums, you can deduct in this area. Prescriptions, insulin, and medical aids. Eyeglasses and contacts are included, and wheelchairs. However, over-the-counter medications, no. Nope, they're not allowed. Here's the transportation. Sorry, it's 18 cents a mile for the medical transportation. If you need to take an airplane, if you need to travel for special medical attention, you and a companion who needs to travel with you, costs are medical expense deductions. Give you an example. This happened almost 12 years ago, 13 years ago. My dad had a benign tumor on one of his valves in his heart. And he went locally and they said, we've never done anything. We've never seen anything like this. We're not comfortable operating on you. Go to Philadelphia. He drove to Philadelphia. They evaluated him there. They said, we're not comfortable operating on you. So it ended up he had to go to the Cleveland Clinic, which is in Cleveland, and it's one of the best heart hospitals in the country, probably the best, and they operated on him there. And they had to do an open heart surgery on him again, and he had had one about 5 years earlier for blocked arteries. So he was there for almost a month between being at the hospital and staying at a hotel there, and my mom was with him. So all of that cost would be deductible as medical expenses for them because they weren't being reimbursed by insurance for meals and lodging. So, the lodging end of it and the personal use of the vehicle, those are the things that would be deductible. Meals are not. Any kind of long-term care facilities you have to pay for, nursing home, out of pocket, deductible if it's for medical reasons. Okay, so if you're interested in learning about all the different kind of medical expenses that can be deducted, you can get an A through Z listing of them, and I'll show you that. Let me go back over to my website so you can see everything. The IRS puts it right out there for us. Go over here. I go to the IRS's publication. It's publication 502. And as you can see, give it a second, there's A, artificial teeth, body scans. So if you're not sure, just go out here and see if it's listed. Now, when it comes to these kind of expenses, we have a little issue. We can add them all up. In order for them to be deductible, they must be greater, so only the amount greater than 7.5% of AGI is actually a medical deduction. Okay, so the higher your AGI gets, the less likely you'll be able to take a medical expense deduction as an itemized deduction. That's the unfortunate part. That's going to be in effect for 2017 and 18. After that, it's going to be 10% of AGI. So what this is saying is, if we do a quick example, let's say you have doctor bills that you paid of $700, you have prescriptions of $1,000, and that's good, $1,700. Your AGI is $50,000. Well, your total potential medical expenses that could be deducted, $1,700. But subtract 50,000 times 7.5%. Oops, 7.5% of AGI, and $3,750. So guess what? You don't get any medical expense deduction. Once your medical expenses are above $3,750, it's that part that would qualify as an itemized deduction in this section. So that's the drawback. Any questions? Okay. Just bring it back to that Schedule A quick. So all of that information is actually entered here. It's all by totals. Tell me all your medical and dental expenses, list your AGI, 7.5% of it, subtract that from line 1, that's how much you can deduct. Let's look at state and local taxes. And this was really under fire during last year at this time when they were looking to change the tax law. New York and California was freaking out. State and local tax deduction. And here's what it basically says. Any state and local income tax can be deducted. And I should say state and local income tax paid during the year is deductible in this section. So in Pennsylvania, we have a state and a local income tax. If we are employees, we'll see the amount on our W-2. That's the amount we paid in. It's at the bottom of it. So we just put those as an itemized deduction. If we're self-employed, we make payments during the year into the state and local governments based on how much money we've been making, estimated payments, just like we do to the federal government. So we would be looking at those amounts to include. Okay. What else? Real estate taxes paid. So property taxes. Real estate taxes on your property, they could be in locally, we have a county, we have a local, and we have a school tax. And that's another thing they're talking about in Pennsylvania, getting rid of the school tax, property tax. But if you own a home, you are paying these, or own any property. These are also deductible and as an itemized deduction. Now they talk more about this in Chapter 14. There's a little gray area here. What happens if you sell your house during the year? How much in real estate taxes can you deduct? And here's the rule. No matter who pays the real estate taxes for the year, you deduct the portion of the year you owned the property. Whether you paid the taxes for the year or the new buyer paid the taxes for the year or some different allocation, that's up to you guys. But you can only deduct the real estate taxes for the portion of the year you own the property, even if you didn't pay it. So if you if the property has $5,000 in real estate taxes for 2018, you owned the property for 100 days. You can deduct 5,000 times 100 days over 365 days as real estate tax deduction, sorry. So 100 divided by 365, so it's about 27%, $1,370 of it. The buyer, or whoever owns the property after that, can deduct the rest. Like I said, that's discussed in Chapter 14, Learning Objective 3, I think that's in. The final type of tax that is in this area is called personal property tax. Now in Pennsylvania, we don't have this, but some states do. Personal property tax is the tax on the value of assets the taxpayer owns. Usually other than property. Property taxes are also considered a personal property tax. But here we're looking at, and this does happen in other states, there's taxes on the value of your vehicles, boats, RVs, jewelry, okay? It could be anything, stocks and bonds that you own. It depends on the state. Florida has a personal property tax. They don't have an income tax because barely anybody works there, right? Everybody's retired. So people aren't out making money at a job that the income tax will help support the state. Instead, they said, oh, well, we'll just tax the property, the vehicles and boats and all the toys everybody has, and that's how we'll bring money into the state. Now, what you have to be careful of, registration is not a personal property tax because registration is normally not based on the value of the item. In Pennsylvania, we have to register our vehicles. Whether you drive a Maserati or a Ford Escort, you're paying $36 or something like that to register your vehicle. So that is not a tax, not deductible. However, South Carolina, I could tell you this, and North Carolina does this too. They have a registration and personal property tax on vehicles. So every year in South Carolina, you'll pay maybe a $20, I don't know what it is, but flat registration fee, no matter what kind of car you drive. Then you pay a personal property tax on the value of the vehicle. This part is deductible. This is a personal property tax that qualifies as the deduction. The $20 part doesn't, but the other does. Also, so you know, when it comes to state and local income taxes, and I should have told you this a few minutes ago, sometimes a state doesn't have, some states don't have income taxes, but they have sales tax. Okay, and I think they're still allowing it for this year. People who don't have income tax in their state got pretty bent out of shape for a while. They're like, wait a second, we don't have income tax, so we can't take a deduction for an itemized deduction. We got these huge sales taxes. We can't deduct those. So Congress came out and said, you can deduct either your state and local income taxes or your sales tax for the year. So if you live in a state that you don't have income taxes, then deduct your sales tax that you paid for the year. If you live in a state that has both, like us, pick. Now here's what came out of the tax law. These used to be, hey, as much as you pay, that's what you can deduct. And this is why California and New York flipped out. In 2018, the total amount that can be deducted for state and local taxes, total of all of these items, $10,000. That's it. If your state and local income taxes and real estate taxes and personal property taxes added up are more than 10 grand, too bad. You can only deduct $10,000. Sometimes I wonder if that was like payback to those states. I don't know, but that's what they decided to do. But it is what it is. That's taxes paid in our Schedule A. Let me go back. So this part will look a little different because they're going to have to put a line in here that says, you know, is this amount over 10,000? Okay, you can only deduct 10,000. But they should have, see, they have income tax or general sales tax. There's your real estate taxes and your personal property taxes. And if you have other local taxes, I'll tell you one that we have locally that you can deduct. It's that LST. We used to call it the OPT tax, the right to work tax. I can't remember what the local service tax, I think it stands for. It's like the $50 that you pay to your local government. That's deductible here as an other tax. It's a local tax you pay. I always deduct it. Per capita tax, if you pay per capita, you know, it's just because you live somewhere. I get a bill every year for like 10 bucks because I exist in my area. They tax me on that. I have to deduct it. So I think they're coming out with a vehicle tax in Luzerne County coming up in 2019. So if you pay that, each vehicle you own, I think it's $5 you're going to have to pay. Probably could deduct that here as well. But if everything added up is more than 10 grand, You can only deduct 10,000 anyway. Okay, so that as far as I wanted to get for today's class. I thank you all for showing up and being here and listening to me. I hope you all have a great Thanksgiving. I'm going to save this and then I'll make it available to you as soon as it's ready, because it'll be an MP4 and you'll be able to access if you need to. But other than that, there's nothing really we need to have due. Let me see, I'm just checking my dates here. 11/29. Yeah, no, we're good. So have a great break and I'll see you Tuesday when we get back.
What?